Okay, hello everybody, and welcome to this week's edition of Selfwealth Live, the technical analysis edition. My name is Roger from Selfwealth, Roger Ruzia. You've got across next to me right now the famous Jason McIntosh of Motion Trader. 30 years in the industry, can't get anyone better really on this show, to be honest, when we want to talk about technical analysis. And that's what this show is all about. It's about learning about the markets from a charting perspective and seeing how we can improve as traders and active investors as well. Welcome, everybody. Welcome, Maurice. Welcome, Bob. Thanks for joining us, and welcome, Jacques, so far. Shoot us a hello message down there. Let us know you can hear us. Obviously, you can hear us. I'd be getting messages if we didn't. So, which is great. Jason, enough from me. How are you today?
Rog, what an introduction. Gives me a lot to live up to.
Exactly.
No, thank you for that. Much always appreciated. Look, I'm good. I'm ready to talk about some charts this week. There's a bit to talk about, a bit of volatility in some of those indices. So it should be interesting. I'm sure there's a few interesting stock codes of yours are going to have later on. So we'll go through those as well.
Fantastic, exactly. So if this is your first time, obviously we are going to analyse the Australian, the US markets and the Hong Kong markets. Any general questions you may have, pop them in the chat, and then we will go through your tickers, all right, from a technical analysis perspective once again. All right, so shoot through any of your tickers that you want us to have a look at towards the end of the show. All right, that said, let's go ahead and display everyone our disclaimers. Thanks, Jace.
So what we always mention before the start of the show, everything today is general commentary only. Doesn't take anyone's personal situation into account. And we have this disclaimer that we pop up each week that just outlines all of that. The other important point is I'm not part of Selfwealth. My business is Motion Trader. You'll see my details at the top, licensing, etc. Selfwealth beneath there. And as I say, general commentary only.
Fantastic. Thanks, Jason. All right. So let's start with our Aussie market. We have broken into all-time highs and come back down. What do you think of what's going on right now, Jace?
Yeah, so a pretty interesting chart to have a look at. So let me just get that up on the screen. So there we go with get rid of that. So there's the ASX 200. And it's quite a bit happening since we caught up last week. So as you noted, Rog, an all-time high for the ASX 200 on Friday, and that was followed by a quick 2.5% sell-off on Monday. And of course, the catalyst for the sell-off was all this talk about tariffs and the impact that could have on global trade and the economy. So there's plenty of discussion out there already on the fundamentals around that. What I'm interested in and what I want to focus on is, of course, what's happening to this price action that we're seeing on the charts and what insights that could give us for helping to manage a portfolio. Now, it's interesting to just step back and consider that on average, the market has about 3 declines of about 5% each year. And of course, there are many more declines, shorter declines of less than 5%. But on average, 3 declines of about 5% a year. Now, the most recent sell-off, it fits the that latter category of all the little ones beneath less than 5%. And you can see the over the last year, you can see 3 of those declines on this chart. So there's one here from April, there's another one here in August, and then one in December. And each time we get one of these sell-offs, many people think it's a start of a crash or some sort of a lengthy bear market, and they go out, they sell stocks they probably shouldn't sell, and more often than not, we find that the market stabilizes and then pushes higher, and that's the course of price action we see within a bullish trend. And I think this is why it's so important to understand the market structure. And I think if you can recognize some of the key features on a chart, then you start to think in terms of probability rather than simply reacting every time we get a sell-off. And the key structure that we discuss pretty much every week, Rog, it's the moving averages. What are the moving averages doing? What is price doing in relation to those moving averages. And for most of the past year, it's been a case of rising moving averages. So I'm using the 50-day and the 100-day moving averages. It's been rising moving averages with price for most of that time being above those rising moving averages. Now, that structure is associated with bull markets, and that continues to be the case with where prices currently are. And I think when this condition is present, the odds favour that sell-offs are simply pullbacks within a rising trend. I think that's the way we treat them until we have reason to do otherwise. We treat pullbacks as temporary setbacks within a rising trend. And that's how we've been approaching the ASX 200 for the last 14 months. I don't think the last couple of days of volatility changes that. So yes, prices have pulled back. It's been 2.5% over a couple of days, but they're still above rising moving averages. So from me, from my perspective, that's not bearish. As things stand, I think the path of least resistance remains to the upside. And this is an environment that I think warrants continuing to be long stocks and also actively looking for opportunities. It's interesting to come across and quickly look at the equal weight. So this is the ASX 200 market capitalisation index. So the biggest stock has the most influence. Now let's go to the equal weight. Now this index will rank the biggest stock and the smallest stock in that top 200 the same. And what I think we're seeing through this last couple of months, I think this is bullish price action. So what we've got here, the equal weight briefly broke to a 3-year high on Friday. So it just got above these highs from December and the high from October. So that briefly took it to a 3-year high. And that placed it just below the all-time high from January 2022. So this is this blue line which I've got above. It's just for a reference point really, because it references this all-time high from back in January 2022. And when I look at this structure that we have, we've got this classic corrective pattern over the 2 months from the October high, and it's that zigzag pattern. I can just draw it here. So you get the high, you get the initial decline, you get a rebound, and then you get a secondary decline. So that's that classic. We see it often. We see it often in price action. We see the zigzag decline, and the second decline fails to sustain the sell-off, and then the market rebounds. And the most recent price action has in fact been that rebound. It's been a strong rally off the January low, taken prices just below the all-time high, and we often see markets pause when they approach previous highs, like the high from October, the high from December, October, then of course the all-time high. So we often see markets pause around previous highs, and this often just allows them to build up the energy required. They might consolidate beneath there, and then often allows that energy to be built up for then a breakout to new highs. And I think the odds favour that's what's happening here. So I'm happy to continue holding stocks that remain in upward trends. And so you note I say upward trends. It's not about holding stocks which are in decline and have been in decline for some time. I want to get rid of those. But if I've got stocks in my portfolio, which I do, which have and are in upward trends, I want to hold on to them. I don't want to sell them every time the market comes back a couple of percent. And I want to use wide trailing stops to help see off these pullbacks that we're invariably going to get along the way. And at some point there will be a high, a lasting high, and there'll be a larger sell-off, but we don't know where that's going to be. So until we get clear signs to the contrary, this remains a case of staying on what is still a bullish trend.
Well, it's really good. Interesting. You say that. Obviously the wide trailing stops helps us stay in positions where we might get freaked out a little bit, which is it's great to always. And we've got a few questions on some of these actually coming up, including one down there, which we'll get onto for sure, Marcus. Let's have a look at the US markets now. Slightly different picture, but not too much.
Yeah, so S&P 500. So we'll start with this, and this has been an eventful couple of weeks, hasn't it? It's so we had a new all-time high about a week and a half ago, and then from there it was two quick declines of around 2.5% and 3%. If you look at the Nasdaq, we'll jump over to the Nasdaq in a moment. The price swings have even been larger, at around 4.5%. So the first decline was, of course, that was all about the Chinese AI. We talked a bit about that last week, and the impact that could have on US stocks and US tech stocks in particular. And then we had the rebound, and then the second decline has, of course, been all about the tariffs. So the big question from my perspective, when I take all this in, is whether the sell-off changes the overall chart structure. And so, look, as a viewer looking at this chart, just think for yourself: has what's happened over the last week, do you think that changes the overall chart structure that's been in place over the last year? And my answer to that is no, it doesn't. Now, it's not to say that things can't evolve, but at this point, it doesn't change the structure. What we have so far are two attention-grabbing headlines. And look, the implication of tariffs could be a significant policy change, but it's still very early in what could happen there. We don't know how that's going to happen, how that could evolve. But at the moment, they're headlines. And the thing with headlines typically aren't a great predictor of where markets are going to go or of key turning points. They certainly can cause some short-term volatility, but it usually takes quite a bit more to change the direction of an established trend. They usually don't just do a U-turn in the space of a week and start heading in the opposite direction. This is where I think the challenge here for a lot of people is that these attention-grabbing news bites or headlines, they often cause emotional reactions, and you can see that in the way prices have responded to the news as it's come out. We've seen those quick headlines, and I think this can be a problem for a lot of people. And this is where, Rog, I think it really helps to understand your price structure and also have a rules-based process of how to respond. So the idea is for me at least, I want to take the emotion out of my decision making and I want to replace it with clinical decision making. So I'm not turning on the news in the morning, seeing a headline going, oh, I better go out and start selling some stocks. It's like it can be a prompt to look at the market and see how the market responds and assess the price action. But I don't want to make emotional decisions. That's where that rules-based process can really help. Despite this volatility, the S&P 500, it's still got these rising moving averages. Now, that hasn't changed over the course of the last couple of weeks. So again, it's a 50-day, the 100-day moving averages. And if we look at yesterday's sell-off in the US, it's really only just brought prices back to the 50-day moving average. And there's already some signs of buying of the dip as now we're getting a bit more information about maybe these tariffs could be delayed or may not even happen at all. We're seeing buying of the dip coming in, and that's what we want to see in a rising trend. There's certainly scope for some more consolidation. Like this market could continue to tread sideways for some period of time. That's particularly so when you look at the Nasdaq. So let's just jump to the Nasdaq for a moment. And when you come over to the Nasdaq, it's been trading in this range. You can see this range the Nasdaq has been in since mid-December. And when I just call up this chart, I look at it on its own merits, I'd describe this as bullish price action. So that's when you get a market that rallies and then trades or consolidates sideways into rising moving averages. That's often a bullish structure, and it's often a structure that creates a platform that then can potentially support a new rally. So that's how I'd be looking at this current price action. And the other interesting thing is you can see that each time the market sells off, buying of the dip quickly comes in and pushes prices higher. And that's happened. We've seen that a couple of times over the last 2 weeks. So there does seem to be that underlying interest in buying dips. That's what we want to see. We want to see these dips being supported rather than follow through selling coming in, pushing the market below the averages. Then you get consolidation beneath the averages. That sets up vulnerability. And then from there, you can look for sell-offs. But we don't have that at the moment. At the moment, we're seeing the dips being actively bought. Of course, there's never any certainties in these situations, but at this point, I think the odds continue to favour the upside. My approach is staying long, actively looking for opportunities, and as always, using those wide trailing stops. Because this is the thing. This is the thing, Rog. I want to stay in winning positions for as long as possible, but I also want to have that escape plan or that escape pathway when conditions do ultimately change, because we know they change at some point, and that's what trailing stops are all about. It's not about predicting where they're going, where markets will peak. It's give them every chance, but when they come back to your exit point, your exit plan point, that's when you leave the scene. But we're not currently there at this point.
Yeah. I have to say, while I was listening to you then, one of the things that I think I've learned from you a lot over our time, Jason, doing these shows is the way, I think back in the day when I was learning technical analysis, I would look at those last couple of peaks or the last three peaks or troughs if that were on a down, obviously, and you'd already call out it's a double top or it's a false break or it's a head and shoulders pattern and all that sort of stuff. And I look at it now, and these things are forming. But I don't really do that as much anymore. I actually am a lot more patient now in seeing things play out, and I'm not really calling these patterns anymore. It's more for me just seeing them, how they play out and how, which direction's going to go, looking for those consolidations, as you just said, being still in that bullish manner with the EMAs moving upwards. Every time they go to those EMAs, they bounce back off, having that consolidation there once again, which can be a level for another bounce, or it could be a level for it to be broken down, obviously. That's just one thing I'm not sure if viewers can relate, but I'm trying to call less of these patterns these days and just using the overall picture and the price action over multiple bars and not just the last couple of weeks, let's say. So
yeah, it's so interesting. I think almost everyone will relate to that, and I relate to that too, because what you described is classic trying to pick the top psychology. You're looking for patterns that indicate that something that's working is going to stop working, and the opposite applies in a falling market. People are always trying to pick the low. Where's the lows going to be? I've spent a long time trying to do those things, and what I've learned over the years is rather than trying to pick the turning points, I can be aware when a market's becoming vulnerable, and I might adjust my risk, but my default position will be to the incumbent trend. So at this point, rather than looking for tops, I'm saying the incumbent trend is up until proven otherwise. Whereas when you start looking for head and shoulders and double tops, you're trying to predict a turn in the market. And often a strong market will punish those who keep trying to pick tops, because the market will keep rolling over the top, and they'll either be getting short and getting stopped out, or they'll be selling their best stocks and then watching their best stocks rally. And trends favour those who want to go with the trend, not those who are trying to pick the demise of the trend. It's something I've learned in the early part of my career, and so now I'm not a predictor. I'm a follower of a trend until I've got good cause to say, okay, this is no longer working. Protect capital, take it to the side, and then wait for the next opportunities.
Yeah, good lessons for sure. All right, what's the Hong Kong looking like? What's the Hang Seng looking like, I should say?
Well, I think the positive here is the Hang Seng is holding on to its recent gains. Had this nice rally off the January low, and it's so far it's holding those gains. So this is different to two previous periods where the market's tried to rally and then it's quickly reversed and gone back down to new lows. So there's a change in the way that the market is currently behaving. And this is still one to watch for me. It could continue, even if this market does continue to hold on to its gains, it could still track sideways for a period of time. There could be more backing and filling for a while. But there are those tentative signs that the buyers are starting to be more active about buying the dips, as opposed to what we've seen in recent months. So something to keep an eye out for. But at the moment, it's still neutral. I'd probably say I've got a bullish bias towards it, but at the moment it's neutral. Not in a hurry to do much. And when we go over to China, it's like I'm just not rushing to get excited about this market at the moment. We still have this ongoing consolidation, and in more recent times, the last few weeks, we've had the consolidation taking place below moving averages, which are rolling over. So that's vulnerable. It creates a vulnerable setup when markets consolidate beneath moving averages, particularly moving averages that are rolling over or trending lower. Now, as I always say, vulnerability isn't a sell signal, but it's just something to be aware of. I don't want to buy into a market which is vulnerable. And if I was in that market, I'd want to be considering where my exit strategies are in the event that there was a breakdown. But that may not happen. It's just being prepared for possibilities at this point. What we need to see for this to become more positive is we need to see a sustained move back above the moving averages. Saw a brief move above the averages last week, but then it was sold into. The selling came in. We want to see above the averages and buying. We want to see a rally extend, not to see a rally sold into and prices decline. So that's the first step, back above the averages, and then these December highs. We want to see these December highs start getting broken, so we start to break that series of lower lows, which is still in place. So for me, it's not a case of trying to pick the low, as we just spoke about. It's wait for clear signals of strength, and until then, this is one for the sidelines.
Oh, beautiful. That's the markets done. And now we've got quite a few general questions which we'll try and go through. The first one's via email from George. So the 70-day rule that you have, I guess this is for holding stocks that aren't going anywhere. How much flexibility do you allow in that stock if it's up or down? Say if it's up 5% or down 5%, will you get rid of it or not after the 70 days?
Now, I'm not quite sure which rule George is referring to. I use a 70-day high as part of the entry part of my entry rules. I'm using moving averages and a 70-day high. But I suspect he's talking about my time exit strategy, and I use 60 trading days.
That's
60
right.
60 is not a special number. 60 basically equates to 3 months. You could use, I've done back testing, and on the back testing, 50 or 70 or 80 or all different. There's it's not like a special figure which magically changes things. You could use a range of different numbers, but I just use 60. It's 3 months, and it gives the stock a good amount of time to get going, because some stocks will trigger a signal through momentum, but then that initial move will then result in the stock then trading sideways maybe for a few weeks to consolidate that initial rally. So I need to give it a bit of time, and but for me, I'm using 3 months now. And my rule for selling is if the stock is in the red after 60 trading days, I'll sell it, and I'll take the capital and I'll put it into something else. And the alternative is just wait for the trailing stop to trigger. But that takes longer. Some stocks meander sideways for 12 months, never hit the stop, and don't really rally. So I'm using that to be more probably efficient with the use of capital. If the stock isn't working, it's like, well, okay, it had signs of momentum. The momentum hasn't really kicked on, so I just move it out. Occasionally I'll look at a stock. It's triggered the 60-day rule, but it's got that technical structure I like, and I think, oh look, I'll just give this a couple of extra days or a little bit longer just to see whether it regains some momentum, and sometimes that's worked well for me. But if it continues to languish, then I just sell it out. it's different people can apply a time exit in different ways, but for me, it's a good way to not get stuck in underperforming stocks for too long. If I'm going to be wrong, and I'm wrong plenty of times, I want to be wrong pretty quickly and pretty cheaply. That's the idea for me of having both a stop loss and a time exit.
All right, beautiful. Thanks for that, Jason. All right, the next question is for Maurice. Great show, learning a lot. Thank you, Maurice. Just wondering how you work out the amount of shares you would buy. Do you use the old 1% rule?
Yeah, I'm using a percentage of capital. Can't remember exactly what it is offhand because it's all like programmed in, so I don't need to think about it every day. It's all just automatically done for me. But I'm using a percentage of capital, and the thing I like about using a percentage of capital is because it dynamically adjusts your position size over time. So as your capital grows, your position size can automatically grow with it without having to make too many decisions, without having to make any decisions really. It will just automatically be sized into larger position sizes. And when we go through a bearish phase and your capital comes down, because capital will pretty much almost always come down in a bearish phase because you give back profits and you get some losses, so you have your capital base might adjust down, and so the position sizing adjusts down accordingly. I find that way works well for me, as opposed to saying, look, I'm just going to do $1,000 a trade or 2,000 or 5,000 a trade, whatever it may be. There's nothing wrong with doing that. That's an easy and simple calculation, doing it that way. But you just don't have that automatic adjustment for your capital increasing or decreasing. So for me, I like the that percentage method.
Okay, fantastic. All right, the next one's from Macouse. It'd be interesting in your view on the 10 ATR, 10 times ATR. If that is a common indicator, does it not signal to the market where many shareholders will bail out and people can buy cheaply?
No, I think few people use something like a 10 ATR. So just explain what an ATR is. So ATR is average true range, or I prefer to say average trading range. So you calculate a stock's average trading range over a period of time. Maybe it's over the last month. You get the average trading range over the last month, and then you multiply that by a number. In this example, 10. And then that will create the you'll use that for your trailing stop. So let's get an example. I'll just choose a stock which I know has been in a big uptrend. I know this because it's a motion trader stock which I have myself. Now let's put on an ATR stop. So this is a 10 ATR stop, and just got to select where the entry point was. So this is where motion trader gave a buy signal. So the shares been declining for some time. Got back above the averages. The averages turned higher. Shares broke higher. It's got an entry signal. So apply a 10 ATR stop. And what we've had, the 10 ATR stop, has done a good job of seeing off all these pullbacks along the way. It typically sits below the 100-day moving average, and it moves high with the share price, all the while giving it plenty of room to move around. And then we get to current day. So the question is this a popular type of trailing stop, and will other traders know there's going to be plenty of activity around a 10 ATR stop where this blue line is? And I think no. I think very few people use something like a 10 ATR stop, because the feedback I often get from people is that it's just too wide. And people say, how could you use such a wide trailing stop? You risk giving back so much money. It's too risky. I'm uncomfortable. I don't want to give back more than, say, 10% of my profits. And arguments like that. That's sort of the pushback I so often get on wide trailing stops. I don't like wide trailing stops. I don't use wide trailing stops because I like seeing my shares come back by 25 or more percent. I'd like to get out within 5% of the high as well. But the tricky part is which of these highs is the one? Which of these highs is the one for your 5% stop or your 10% stock or your 20% stop? You're going to get taken out so many times. If you have set close stops, like most people do, if they use stops at all, it's just too close. So for many people, they're uncomfortable with the wide stop. But unfortunately, with the stock market doesn't really care about what we're comfortable with. It's a case of, if you want to play the game, I think it's a case of use what works, not what's comfortable. What's comfortable is often not so profitable. What's less comfortable, you're probably more likely to find strategies that work because they're harder emotionally for a lot of people to apply. So no, I don't think there's a whole lot of traders watching the 10 ATR at all. And if you can ride this sort of trend, and your stock comes back to the stop, and you might get if you get a few cents, you miss a few extra cents because there's some movement around there, which I probably don't think there is. It probably doesn't matter too much. It's like, this is probably what is this? It's like a 400 or 500% gain, I think, in this stock. So I think use strategies that work, and that's wide trailing stops.
Okay, fantastic. The next question is from Mike. If moving averages cross, would you adjust your stop loss, and by how much?
So we're talking about if a stock is in an uptrend and the moving averages cross. No, I don't adjust. I don't adjust the stop loss. I'll see if I can find an example. Just go off the top of my head and just look for some. Well, yeah. Look, here's an example. This is I've got this stock myself. This is how I was able to quickly jump to the example. Now let me put that stop loss on again, the 10 ATR. So I can't remember where I got in, but it's a Motion Trader stock, and Motion Trader's entry was back down here back in January 23. I'm probably in somewhere similar. It's a gold stock, Emerald Resources, EMR. It's a gold stock. It's been this nice uptrend for a couple of years now, a little bit over a couple of years. This is what I do. I call my business Motion Trader, but it's really active investing. It's like, it's getting in stocks, and if they're working, let them keep working, give them room to move around. And the best stocks could last from 1 to 3 years within large trends. And that's been the case here. Look at all these pullbacks back to the moving averages. So if you're using the 100-day moving average as your stop, you've been stopped out many times, and you haven't been able to stay on this trend. That's why my trailing stop and why I suggest these wide trailing stops below the 100-day moving average, because big trends you will see often several times where they come back and test the 100 and even breach the 100-day moving average. That's why I'm giving them that extra room to move around. Now, if I tighten my stop when the moving averages turn down and cross, like this example here, that this happens, like where we can see this period just over from the last couple of months, where prices peaked in October. They've had a larger pullback. They got really close. I thought the stock was about to trigger the stop, but it didn't. It managed to. I didn't preempt it hitting the stop, so I held the position. I'm still holding it now. It's back up near its highs. I didn't sell any. I didn't reduce position. It went through a period of vulnerability. We often talk about when a stock's trading below moving averages, which are rolling over. I talk about how this is a vulnerable period for a stock, and it was. This is where the trend could have ended for Emerald Resources. There was another bout of selling, but then the dip was bought fairly quickly, and pushed prices back up. I wouldn't add to a position, as I always say. I don't want to add to a position when it's vulnerable, but I'm also not selling a position, which I have, because I do know that stocks in trends can spend a relatively short period of time below moving averages, and moving averages can roll for a period during deeper consolidations, but they can still hold above these wide trailing stops. That's why they're wide. They're wide by design to see off this sort of period. This is what's that? That's a 27% pullback. So the stop isn't actually that far below the high at around 28% or so. Sometimes the stops are even deeper. They might be 30 or 35, even 40% in more volatile stocks. This is why we're using an ATR. It tailors the trailing stop to the volatility of the stock. So yeah, look, I want to give my stocks every possible chance to kick on and keep moving up. Here's a more volatile example, which just springs to mind. Look, we're getting into trailing stops now and the moving average. So I won't keep going down this path. It'll all take too long. But yeah, simple answer, Rog. I don't adjust positions typically when the moving averages cross, as long as the stock is above that trailing stop.
Yeah, it's one of those things that gets asked a lot, actually. Which one's your priority? The price going underneath the moving averages, or the ATR? And I think you've answered it quite clearly. Your ATR, your wide ATR trailing stop is your primary get out if it triggers that line, right? So
here's an example from a while ago. I just quickly look at this because it's interesting. It's a stock called Codan. So we're going back to 2017 for this. There'll be many more recent examples, but this is one. I need things that quickly come to mind, and I remember this one for this very reason. Let me just put a trailing stop on. Now, look at this stock. So it's had this nice trending period, and big upward phases often lead to lengthy consolidations where the price will move sideways or pull back. But the wide trailing stop has been able to see off this, and this is what's that? That's actually a 12-month consolidation. There's March 17 and there's March 18. So for 12 months, the price has gone sideways. It's chopped back and forth across the moving averages. The moving averages did actually turn down at one point. So it had this period of vulnerability, which didn't turn into a trend change. And it was just oscillating either side of the averages. Now, we often see this in trending in longer medium-term type trends. We get these lengthy sideways consolidations where the price will oscillate either side of the averages. The averages may even cross during that period, but the wide trailing stop, it can help see that period off. And then we saw a similar period occur in 2018, 2019, where again, you've got that oscillation either side of the averages. And but the wide trailing stop, again, keeps you in the trade. And you can see how long this particular trade goes for. It goes from June 2016 and hits a stop in March 2020. So we're almost got a 4-year upward trend, which was completely investable and keepable, and being held within a portfolio. And it's a significant gain from, say, around $1.20 to $5.70. You work out the maths on that. It's a big double-digit return. This is the beauty of the wide trailing stop, and this is why I don't mess around with positions. Usually, unless I've got a really large profit, I might scale down sometimes, but I usually won't mess with my position. I just sit and ride it through as long as it's above that trailing stop.
All right, fantastic. Thank you for summarising there, Jace. One more general question, which I think would be a pretty simple answer for you there, Jay. Answer from Bob. With the Hong Kong market, do you consider political risk, or is that a redundant perspective?
Yeah, I think we probably should consider risks like that. Like you particularly see that in some of the African-based mining stocks. It might be an ASX-listed company based in Perth, but their operations in a small African nation. And I think you've got to consider political risk. There have been recent cases where stocks have been doing really well, and Resolute comes to mind. So Resolute Mining, gold play, I can't remember the country it's in. It had been up at a multi-year high, and then the government decided they wanted to do whatever. They got the CEO, threw him in jail for a period of time, and that's that if you're investing in a country like Australia or Canada or the US, if like a gold mine is located in Australia, Canada, or the US, you probably don't have to worry about that. But when you're in some of these less politically stable areas, political risk is an issue. Now, Hong Kong is another situation altogether. I'm probably less concerned of political risk in Hong Kong than maybe in some individual stocks, but it's something we do need to. It's worth more than a passing thought about, depending on, and especially if you're putting a large portion of funds into a Hong Kong ETF or a Chinese ETF. Is there political risks that I need to consider? I don't know. I don't have the answer to that, but I think it's a reasonable consideration, and particularly with individual stocks like this example with Resolute. So it's a little bit away from what Bob's asking with Hong Kong, but it is an example of where we do need to consider. Is there political risk in some of these stocks which operate in less stable jurisdictions?
Yeah, good answer. I think it's always got to be, whilst we always say we're technical analysts here, I think it's important to understand what's going on in other parts of the world a little bit from an overview perspective as well. So, all right, let's go on to some tickers here. Let's start off with CPU, Jace. CPU.
Nice uptrend, all still in place. Yeah, so it's recently broken. So it's really recently broken out of this ranging period. You can see, like, I'm just roughly drawing this. You got the tops, and then you got this series of rising lows. That's not a valid line. I'm just quickly drawing stuff in so we can get a visual on how the price had kind of been coiling for a couple of years, and we've got the breakout in November. So this is a stock. If I had this stock, I'd be happy to continue to hold it. It has had that strong run off the lows, and it wouldn't be surprising to see it consolidate a bit into the moving averages. So I probably wouldn't be in a hurry to buy it now. But if I had it, I'd be more than happy to let it keep running. That wide trailing stop underneath the 100-day moving average somewhere. So give it plenty of room to have some consolidation should that occur. But the trend's in place. Happy holding.
All right, M7T.
Well, this is a no at the moment for me from a technical perspective, because the downtrend's still in place. We've still got these declining moving averages, notwithstanding this recent strong rally. So this could be a turning point, but I use these slower moving averages. Like if you're using 10 and 20-day moving averages, maybe you're starting to get a signal. But the problem, it's not so much a problem, but the thing to be aware of with faster moving averages is that you're going to get more false signals that don't carry through. So I just use my these longer 1500-day. It's like look, here was a strong rally in July last year. Strong rally into the averages, and the rally was sold into. Price fell, consolidated below the averages, fell again, consolidated sideways underneath the averages, fell again. These are these vulnerable periods where it consolidates below the averages. So is this the one which is going to actually hold? It could be. It could be. If now, so I wouldn't. This is a stock I might continue to watch, because certainly is a possibility that this could be like a final low, and maybe it is starting to do a turn. But if that were the case, I'd then expect to see maybe some sideways price action and then another break from there, and that for me could be maybe an entry point. So it's probably a little bit early for me. If someone was long already, I'd be probably looking at a like, how would you manage risk around a stock like this? Like it's about 30% down to the January low. Like that's one area where a stop could be. Like if by chance I was long this stock, I'd probably say, look, I'll give it the benefit of the doubt. I'll see what it does. I'll have my stop below the January low, probably 30%. But yeah, I probably wouldn't come in right now and buy it. Keep an eye on it, but probably a little bit early. Like, look at these other examples where we've had strong rallies into the moving averages, and they don't mark turning points. The market sells them again, so it still warrants, I think, a little bit of care.
All right. Let's have a look at EMC, please.
Yeah. Okay. Well, yeah. I think there's a play here. It's we've got the rising moving averages. It seems to be a case, like, you just look at how the price action has evolved since you can come back to 24. It seems to be a case of the sensitivity seems to be the upside. So we seem to get strong rallies, and the pullbacks come back to the averages. Strong rallies, and then we get these sideways consolidations into the averages. Even in since September, again, we've got a decent sort of rally, and we've got a shorter consolidation into the averages. Gain a rally sideways into the averages. Seems to be like, when you see that, I wonder, like, it's like there's the buyers beneath the market, and they keep ratcheting up their bids and catching it on the pullback, so accumulating, and then it has these pushes to the upside. So I don't know anything about this company, don't know what they do, but just based on the price action, this is going to count as probably a highly speculative play, but like, it could be like, if somebody wanted to go with this emerging momentum, even buying it at current levels, putting a stop loss probably below the 100-day moving average, below these lows from December, January, it probably needs at least a 23% stop to give it plenty of room. But I think it's asymmetric in that, like, say you say, look, I'll give it 23%, but is this a stock that could double? Could it run to 30 cents or more? It could. I don't know whether it will, but it could. So it does shape up from a risk reward perspective for somebody who wants something which is more down that speculative end.
All right. Let's now have a look at that was FEX. FEX.
It's maybe something shaping up. Yeah, I'm just looking at what I've drawn in the past. So we had this big consolidation for several years, and it broke high. It was all looking promising. Then it all fell back on itself. And this is the thing: not every trend extends and goes on to be a multi-100% winner. It's some trends that look highly prospective just fizzle out and come back. That's why we spread risk, because we never know which ones are going to deliver the really big payoff. So spread risk. It's having a foot in lots of different camps, and see which ones deliver. And looking at this now, it's probably just a little bit early. It's back above the moving averages. The moving average is starting to turn. I'd like to see whether it can hold on to these recent gains. So we've got the recent gains off the December low. If we got price action, which saw the price action sort of like sideways, maybe we got the sort of sideways price action for maybe several weeks. The moving averages actually cross and turn higher. Then maybe it could be buying a subsequent breakout. Like, I don't know, maybe we don't get that price action at all. But this is what I'd be looking at for a setup to get in. If we get that, great. If we don't, we don't, and don't need to worry about it. If this rally quickly fizzles out and prices, back down here, I don't need to worry about it. So I'm looking for a particular type of price action to see whether this is the early stages of a turn also got the possibility that you can see that actually is a bit of a trading range, which is formed. You can see this contracting range prices has broken out of. So if this breakout holds, again, going back to that, what I drew in initially, if we get that, we've got that initial breakout. If we get some sideways, the dip being supported, and then from there we look at, do we get a continued rally? So it's probably this secondary break. I'd be look, I'd probably be more interested on that secondary break simply because of where the moving averages are. The moving averages haven't quite crossed yet to give me that extra confirmation that this trend might be turning up. But it's certainly one to keep an eye on. Rog, there's potential there, and there's certainly ways to manage risk around getting involved now or soon, and manage that risk with a stop.
All right. Can we please revisit your comments on ARB? So I guess we looked at ARB last week, but I believe so. But let's have a look at it.
Yeah, so it's now gone from vulnerable to breaking down. This is what we talk about: consolidating below moving averages, which are rolling over. Now, last week I think I would have said it's vulnerable, but it hasn't broken down. So I'll be watching my trailing stop. And so, like if there was, so let's put a 10 ATR on this. So if I was using a 10 ATR on this, I'd now be exiting. I'd be exiting on the basis of it. Like we looked at Emerald Resources earlier, EMR, where it held its movement towards the trailing stop. It was vulnerable, but it didn't break down. It then rallied. This one hasn't stabilized and rallied. It's then now rolled over. This is this is where the vulnerability comes in. You get that sideways movement, and then you get the break. It's a stock I'd be following my exit strategy if of course the 10 ATR was the exit strategy. But for me, this would be a stock I'd be moving on, because the risk for me is that this continues to unravel to the downside, and I don't want to be in a situation where I keep getting further losses and going, oh, look, but I'm going to just give it a little bit longer. I'll give it a little bit longer, because that's a slippery slope, Rog, that we get on when we say, look, I'm just going to keep giving it a little bit longer, because, what if the stock ends up, down here, back down to 30 or below? Then people will turn around and say, now it's too late to sell, so I'm going to hold on, and then the whole thing can just keep playing out. I don't know what's going to happen with this one. But for me, the trend's no longer to the upside. It's shifting to the downside. I'd rather protect capital. If it bottoms and turns back up, well, so be it. I might be able to get back in later on. But I'm now in capital preservation mode. And for me, may be different for someone else. Someone else might be in for different reasons. But for me, it's I'd be following my exit strategy, which would be getting me out.
Okay, fantastic. Thank you for that. Let's look at NBX.
Well, this is a no for me at the moment, because we're trading to the wrong side of moving averages, which are still sloping down. So for me, the risk is that this continues to weaken. Now, there is going to be some support around these previous lows. So look, one strategy is for somebody who wants to try and pick a low. It's buy at current levels, put a stop not too far below the previous lows. That's probably an obvious place to have stops. So you might find there are others who are thinking the same thing. So if it breaks, you could get a bit of downside volatility, but nonetheless, it's a valid play to sort of buy above support, stop below support. If you want to try and pick a low, we discussed this earlier. I'd prefer just to go with the prevailing trend, which is down. So I wouldn't be picking a low. I'd be just standing to the side and leaving it alone and waiting for more momentum to the upside, and then considering it. So giving up the potential for early gains, but reducing my risk of getting into a stock which remains in a downtrend.
All right, thank you. ASL.
Well, this is a stock which I was holding. Now I sold this, like not dissimilar to ARB, which we just looked at, where we had this consolidation starting to occur below moving averages, which were starting to lose their momentum. I also had the ATR stop, and I think my exit point was pretty much around where the cursor is now, above the lows, just as prices were breaking down. So I sold it from my portfolio. I left the motion trader portfolio, and it's fallen a bit further. Now it's rebounded. So and this will happen. A trailing stop isn't like a line in the sand where as soon as it's hit, we go, okay, well this stock's gone. It's going to fall 50%. Don't know that at all. It's just a point of managing risk, where we say, okay, I've given back enough. I've got to now protect the value of the capital, which is still intact, rather than just roll the dice and hope it comes good. It's risk management. It's not a signal that the stock is going to continue unraveling. That's a risk, but it's not what the trailing stop is telling you. We've now got this stock back above the averages. So if someone saw off this sell-off, that's great, and now it's out of its vulnerable position for now. It's back above the moving averages. The moving average is showing some signs of lifting off the bottom. It's in that precious metal space, which has been doing well. Maybe this was an ugly sell-off, which was just a little bit too ugly for a 10 ATR stop loss, but it has maybe stabilised and it is going to resume some upward momentum. I probably wouldn't consider re-entering just yet. It's not going to be a new motion trader signal for a while because of the way the rules work. But if we've got this sort of price action again, bit of sideways and then a breakout with the moving averages coming up, maybe a breakout from a sideways period would be a trigger to get back in. But for now, the vulnerability, which was evident back in November into December, that now seems to have passed.
All right. Let's look at MME then.
Upward trend continues to extend. Geez, this one's come from great heights and really collapsed. And this is why we have exit strategies. It's like we're just talking about stocks like ARB and ASL. Like, why do you get out? Why do you not give them a little bit longer? This is why you don't give them a little bit longer, because this can and it does happen, and it happens reasonably often in stocks. If you give the wrong stock a little bit too much leash, you can end up with a disaster. So having that disciplined exit strategy, disciplined and consistent, and there's always going to be some that rebound after you sell them. They don't ruin your portfolio. The ones like the likes of MME, if you're holding from the highs, they're the ones that can really run amok in the portfolio. Looking at it now, though, another story. We now have rising moving averages and prices trending higher. If I was in this, I'd continue holding it, like classic price action. Rally sideways into the moving averages, rally again. It's had a bit of a run from the November low. Maybe there's going to be some consolidation sometime soon. So again, this is why we've got that wide trailing stop back below the 100-day moving average to see off any potential consolidation. Probably not rushing to buy it just at the moment. We've got some volatility in the markets generally. It's a stock which has had a strong run. I'd probably wait for the next consolidation, see what it looks like, then consider maybe adding or entering. But if I had it, I'd be holding it.
All right, fantastic. Air New Zealand, it's AIZ.
Yeah, it's positive price action after a lengthy decline. It's so I like the way it's sort of stepping higher. So it rallies, and then we get the sideways consolidation, holds onto its gains, rallies, holds onto its gains, sideways consolidation. Now we're rallying again. Uh, so let's just measure this out. I guess it could be bought. I think this is a stock that there's momentum there at the moment. So it's a stock that could be bought at current levels with say a 12% stop, which is for a lower price stock. It's like a 57-cent stock. A 12% stock is a 12% stop is like it's a relatively tight initial stop. See whether it continues to gain momentum. It has those asymmetric properties in that the upside seems to have greater potential than a 12% stop. So I think this ticks several boxes in that it's above rising moving averages. It's rallying and then holding gains. It's got current momentum. Now, none of that means that it's going to be a superstar or that it's going to keep rising. But I think you buy stocks with those characteristics. I think you put the odds in your favour that you can get on something that goes really well, and then you let it run with those wide stops. And if it stops performing, you move it on. But this is a sort of stock I want to build what I'd call a strong stock bias into my portfolio with. So yeah, one which I think is worth considering.
All right. CCA.
Yeah, not really doing it at the moment, this stock. Like it showed those initial signs, positive signs back in July last year, where you see we've got this big sideways period, starts to break higher. And this is the thing I always talk about with these breakouts. Not every breakout's going to stick. So it started to break high, then it quickly came back to the averages. It started to stabilise and broke lower again. It's now spending time below moving averages, which is declining. It has flipped to the positive side of the averages, but it's not a stock I'd be looking to enter at this stage. It needs to show some more positive signs, like stabilising now around the moving averages and then starting to break higher again, getting back above the February high. So I'd steer clear of this one for the moment. If it's not a stock I was in. If I was in it, well, I've got to work out where's my exit strategy. There's a clear point around that January low to consider for an exit strategy. If it stalls here and continues to deteriorate, maybe a break below the January low would be an exit trigger. But in terms of buying, I can see how something positive could develop here. If we were to get that sideways price action for a bit, and then from there we start to break higher. That could be an entry point, but for now, it's for me it'd just be a watch.
The next one is a question from Andrew, and it's: can we have a look at the CTXAY? So we'll start with that CTXAY. I'm not sure what that is exactly. Over the counter, and then versus the EWA ETF. Can you do a comparison? Yeah. ETF. Is there an ETF in America there? All right. Yeah. Doesn't really. Maybe we can have a look at them. Have a quick look anyway. But maybe if you want to elaborate there, Andrew, what we're exactly looking at.
Yeah, probably need to know a little bit more about what we're looking at, because this is
an over-the-counter stock, so we can't really trade that on platform. But
okay, and the other one was ETA, wasn't it?
EWA ETF. I'm assuming it's that American one.
iShares Australian Index Fund. So yeah, I'm not really sure what we're getting at with this, because that's just going to be like an ASX 200 but in
Well,
US
let's
dollars.
move on. Well, if Andrew, if we have time, we might revisit, but let's move on. So just need a bit more context around what we're comparing there.
At this point, this stock's in a downtrend, so it's not one I'd be looking at. But it'd be good to know. Good to know what it actually is that we're
All
trying
right.
to
The next one
assess.
is the 360 on the ASX.
Yeah, and this is one where the uptrend remains in place. Rising moving averages, price above the averages. It's motion trader stock. It's been in the motion trader portfolio for some time. It's like, yeah, wide trailing stop, but we've got this consolidation period going on at the moment along the moving averages, and that's fine. We've seen this sort of price action before where it consolidates around the moving averages and then it's pushed higher. So I would say I would be looking at it on the basis of that. I think the odds favour that it's another period where it's consolidation and then it's higher. I think that's the basis we should be working on. Of course, that doesn't mean that's going to happen. It could break down, but I think the odds favour the prevailing trend, which at this point is up. So I think consolidation, and then that sets the platform for the next rally. I think that's the way to approach this one. But of course, should that not play out, there's an exit strategy, which would be the trailing stop, which is below the January low.
All right, we've got quite a few to get through here, Jace, just as an FYI. So let's just quick fire through them. NASDAQ, LIF on the NASDAQ.
Okay, not having much luck with this one.
I think it might be missing another letter, just. So if you want to let us know, that would be great. We got something? That's okay.
Oh, hang on. What's this? Well, that's 360 on the live 360 on the Nasdaq. It's going to be the same. It's the same. Well, there's not as much data on the Nasdaq, surprisingly, but it's the same story as the ASX listed one. It's going to be a little bit different because there's a currency switch, but I'd be using the ASX listing to get guidance because it's got a deeper price history. But you can already see the moving averages starting to populate and prices consolidating around the averages. So just as I said for 360 on the ASX.
Okay. CTD, sorry, CTD.
Yeah, I think there's signs of an emerging trend. So it's been out of favour for a while, this period below the averages. It's back above the averages. The averages are pushing higher. It ticks those boxes. There's emerging momentum. So we've just got to see whether this emerging momentum actually turns into more of a trending phase. But it does have, see these lows. The lows are getting higher. So we've got rising lows. We have rising highs. So these are all building blocks of momentum, building blocks of a trend. Now this could consolidate, as you've seen. We've had these rallies and then it has these deeper consolidations. It's done this a couple of times: rallies, deep consolidations. That's probably the one sort of query around this. So it's had a big rally. Is it going to have another deeper consolidation? It's been a bit of a messy rally so far in terms of these deeper consolidations, but it does seem to have those building blocks there. So it'll be one to keep an eye on, see whether it can get a more smoother and consistent rally going on.
Okay, the next one is IDX.
And this is just consolidating along the moving averages. I'd favour the upside. I'd give the upside the bias here because that's the incumbent trend. The incumbent trend has been up. It's had a big rally and it's consolidated. It's just been part of a merger. It's merged with or it's taken over another company. I've forgotten the code. This is a motion trader stock and it took over a motion trader stock. And they're both now under this one code IDX. It's consolidating along the averages. I think this is creating the platform for another rally. So if I had this, I'd be happy holding it. But as always, I've got a stop loss in case it breaks down. But at this point, favouring the upside.
Yeah, fantastic. Let's look at SPK.
No, it's like a 1 cent stock, and there's not really there's nothing to go on here. This is just meandering along bumping along the bottom really. There's no momentum either way. It's I've got to just leave this one alone. I want to trade with momentum. So, the first step would be breaking above the October high. But these these stocks often don't come to anything, and you end up percentage wise having to use large stops a lot of the time to trade them. So I'd just leave it alone. But if I were to play it, I'd be wanting to buy into momentum and then figure out where can I place a stop loss, which isn't going to cost me too much if I'm wrong.
Mm-hmm. All right, the next one's ASB.
Trend remains up. It's So this is a shipbuilder, Austal over in WA, and motion trader stock. Initial signals were probably back here around February 24. A wide trailing stop, I think, was able to see off that correction in September, and it's been a nice strong trend since then. If I was in this one, I'd be happy to stay in it, and this is why we use wide trailing stops. Look at some of these pullbacks. They are larger pullbacks, and if you're using a 10% trailing stop, like what is out of interest? What's this one here? That's a 20% pullback. So if you're using a 10 or a 15% stop, you just can't stay on board. You get knocked out all the time. So wider stop, even with it up at these highs, my stop would still be back here below the 100-day moving average. But if I'm in it, I'm happy to stay in it, see where it goes.
Okay, fantastic. We've got FRM. Egg prices are forecast to soar this year, according to Jay.
Don't have the momentum there at the moment. It's just trundling along sideways. But is it starting to? We are getting a bit of upward slant on these moving averages. So maybe there's some momentum starting to build, but it really is too early. If someone really liked the story and wanted to punt this very very early possible momentum, even buying at current levels, having a stop back below the 100-day moving average, you're looking at 28% and might not be much volume there. So you're probably looking at about, say a 30% stop loss just to play in this one being a 15-cent stock. So they do come with their challenges, these lower price stocks. Not enough momentum for me at the moment, but there is some sort of tentative sign there could be some momentum building.
All right, ARB. Oh, sorry, no, we've already done that one. Of course, he's just saying thank you. Let's get on to ACF.
Again, tentative signs that there could be some momentum re-emerging. You can just see there's some resistance recently broke through at around $1.11. Moving averages are higher. Prices moving a bit higher. I'd want to see it hold above this breakout here at around $1.11. So if we get a little bit of sideways and then a break above this high from January, that'd be a sign of some more momentum. Thing to keep in mind with this is it's already been a big upward trending stock and may not reproduce the same sort of trend we saw from 21 through to 24. It might take a longer period of consolidation where it does sort of rally a bit, but then it comes back, falls back within the range, and we don't get a clear, consistent trend re-emerging. But we don't know. Sometimes these trends do re-emerge. So if somebody wanted to go with that initial momentum, we've got that breakout there, and it's easily managed with a relatively close stop just below the 100-day moving average, which would be around only maybe 8%. So it could be a relatively low-risk play getting in to see where the momentum emerges. But that would be my hesitation with this one, being that it has been a strong performer, that a lengthier consolidation ultimately does develop.
Okay, the next one we'll look at is GDX, please.
So the gold miners index, there's a local listing and a US listing. I'll quickly look at the local listing. So the local listing is approaching its highs from October. And it does look like it's coming out of this large basing phase during 21 through to 2024. This is one I'd just keep holding. I think this could be a core holding in a portfolio. If like rather than going out and organising your own gold stocks, if you just like the idea of gold stocks generally, this can be a simple way to do it. I've got this ETF myself. The downside with an ETF like GDX is its largest holding is like Newmont and then Barrick, and those bigger ones, bigger gold companies, they've been the ones which have been dragging the chain, and you've had stocks like Evolution and some of the other mid-tier North American and Canadian stocks which have been doing really well. So you're going to be less weighted to them and more into the big ones like Newmont. But nonetheless, if gold is going to be a play moving forward, GDX is a good way to have some exposure. Trend here is up. Looks to be. Let me just have a quick look at the US listing. Like it's not as the recent uplift isn't as pronounced in the US one. Like part of what we saw in the ASX listing is due to the Aussie dollar falling, so it makes it look stronger in Aussie dollars than it is in US dollars. The US dollar version, it's like we've had the rally off the February 2024 low and that large correction. But again, this does seem to be regaining momentum. It's gone from getting itself into a vulnerable position to being back above the moving averages. So, yeah, look, I like gold generally, and I think this is for a lot of people, this is probably a good way to play gold stocks.
All right, I think we will do one more here, AFG at the 1 o'clock mark here. Otherwise, we're probably going to go well beyond everyone's time. So let's just finish off with this one here. So apologies if we didn't get to all your tickers for today. Let's finish off with AFG.
Well, this is interesting. Is this a basing period that it's been in over the last couple of years? Like you can see this large fall from the 2021 highs. And I just wonder, is this like a basing period going on, which maybe it's coming to an end. I'm looking at the price action of the July low. Like that looks like an impulsive rally. So where you get these strong rallies. And then from the September high, that looks like a corrective type of consolidation where it's choppy and it's all overlapping and it just moves along the moving averages. So strong rally, consolidation. You could put some Fibonacci's on that, and you can see the consolidation came back to about the 50% mark. So Fibonacci's, you use the low point and the high point, and it just gives you a guide to what a proportional correction could be. I don't trade off them, but it's nice to see that proportional pullback, proportional in terms of time and price. So I think it's been long enough in time and deep enough in price to say it's corrected that initial rally, and now it looks like there's some momentum coming in. So is this starting to break higher? I think there's a case here where we could say, look, let's just wait for the next consolidation. Let's see if we get some of that, and then the moving averages start to move higher, and then we buy the next breakout, maybe around $1.73 or something, and then we could have a case where we've got a bit of overhead resistance, and then we buy the breakout there. So yeah, look, you can see how something is potentially developing here. Stop loss wise, we've got the low here from January. That would be a good point for a stop. So below the moving averages, below a recent low. Could be bought here, or it could wait for the consolidation and buy a breakout, or buy a pullback to the moving averages. The moving averages go up and the share price tracks sideways. That could be a buy point. Several ways it could be played. I think they all revolve around having an exit point, probably somewhere around the January low. If it runs, great. Let it run. It's asymmetric, lots of upside possibility. But if it fails, we've got a clear cut way out. Very interesting stock, worth keeping an eye on.
All right, beautiful. Good one to end up on. Thank you, everyone, for coming once again today. Thank you for coming with your questions. Thank you for coming for your tickers. Thank you, Jason, for your amazing guidance on our systems and our, how we can manage our portfolios and protect our capital as well as grow it. Just remember, if you can, don't forget to like and subscribe on our videos and shoot us a comment. Any questions you might have pre-show, put them in the comments. I'm reading each week as well, so I'll pick them out and then we can answer them in the show. Or you can certainly email us as well. Just shoot me an email at support@selfwealth.com.au, and you can also contact Jason over at motiontrader.com.au about his service. Don't forget as well, once again, I'm from Selfwealth. If you want to try out our service, there's a link down below for some free trades. If you want to try out Jason's trial and his service at Motion Trader, there's a link down below for him as well. Certainly worth it. Have a look at that as well. Otherwise, thanks again, Jace. Much appreciated.
Rog, that was fun. We covered a whole lot of ground, looked at a lot of stocks, and hopefully it's been interesting and fun for the viewers as well.
Beautiful. All right, guys. We hope you have a great week ahead. Stay safe, and we'll see you all next week. Take care, everyone. Bye-bye.